Just 12 hours ago, Yahoo Finance posted this infographic on their Instagram account. Markets wrap up in a rip-roaring first half of 2024, stacking up the performance of the major three US indexes, the Dow, the S&P 500, and the Nasdaq. And 2024 was nothing short of extraordinary, with the S&P up nearly 15%, the Nasdaq at an eye-watering 18% year to date. So let's not forget that we are only halfway into the year and we are clearly outperforming the conventional wisdom of only growing between 7 to 10% annually. I mean, that's what at least most professionals say. So accompanying this graph is a caption that states, Wall Street cast off fears of a US recession and never looked back, blazing a record-shattering path in the first half of 2024, fueled by muscular earnings and AI exuberance, unquote. Muscular earnings, that I can understand. But AI exuberance, that's fairly interesting. So I went ahead to Google the definition of exuberance. And at least based on the definition of the Oxford Dictionary, defines it as the quality of being full of energy, excitement, and cheerfulness. And when I looked at the synonyms section, I saw the few words: exhilaration, enthusiasm, euphoria. Wait a minute, euphoria? That sounds pretty familiar. Right, no wonder I've seen euphoria before. And most of you have probably came across this psychology of a market cycle chart. I mean, that's basically investing 101. So does this mean that, hey, Yahoo Finance is insinuating that we are near the peak for many of these AI names, considering the so-called AI exuberance? So in this video, I'll be exploring some of these claims around how expensive and overvalued some of these AI stocks are, and what I personally think and how I would navigate this seemingly exuberant market, since the index doesn't seem to be taking a breather and it keeps on climbing to a new all-time high. So I would also need your help with bringing the like button to an all-time high too, if you don't mind. The beautiful thing about the internet is that information is truly at your fingertips. I was just looking for a few potential arguments for why the stock market might be expensive, especially for this video, and just a quick search, and I'm spoiled for choices. Hey investors, now you can get up to 7% in money bull interest for up to 180 days with returns of up to 3,500 US dollars. So Moneybull is open to all Webull accounts from June onwards for you to access easily. Previously, it was only applicable to margin accounts. Additionally, for those of you who would like to trade, deposit minimum 2,000 US dollars and complete 3 US buy trades and maintain until the 31st of July 2024 to get 80 US dollars worth of cash vouchers. On a much higher tier, deposit minimally 10,000 US dollars, complete 5 US buy trades, and maintain it until the 31st of July 2024 to get 400 US dollars worth of cash vouchers. So if you're looking to invest in the US market, consider switching over to Webull. So known for its low trading fees, intuitive interface, and powerful tools, Webull could be your ideal trading platform. Additionally, Webull's latest Transfer In promo provides attractive rewards for both new and existing users who haven't transferred shares to Webull before. You can select a right tier to initiate your share transfer and fulfill the maintenance requirement to get up to 1,500 US dollars worth of trading vouchers, plus up to 150 US dollars worth of transfer out fee subsidy upon successful transfer in. So sign up now with the link below and grab your rewards today. So this tweet from Kobese Letter, the S&P tech sector price to sales has skyrocketed to a record 10 times, and this ratio actually exceeded the previous 2021 record and is now higher than in the 2000 dot-com bubble peak. So if you think about it intuitively, what are they implying? Are we in a dot-com 2.0 era? So is this bubble waiting to be burst? Following up with that, it's also the first time in history that the Magnificent Seven accounts for over 30% of the S&P 500. And if these stocks are as overvalued as the multiple suggests, the rally could be at risk. For now, no one seems to care. So it sounds really scary, right? So even Thomas commented on that post, I do care. I'm thinking of getting out soon, unquote. Now, moving on to the next one, a survey done by Bloomberg. So Bloomberg essentially consulted 568 investors about their views on the S&P 500 today. And more than half of them said that it is currently overpriced. And by comparison, 26% and 22% of them see the US credit market and gold as expensive. So relatively, the stock market has more than 2 times of the investor base thinking that it's overvalued. So another account also citing Goldman Sachs investment research, arguing that the US equity valuations are still high relative to the macro environment. So this is essentially measured by the gap between the actual Shiller cyclical adjusted PE ratio and the macro consistent Shiller PE predicted by the Goldman macro model, suggesting that US stocks are currently 40% overvalued. And the last one states that, hey, the US top 7 stocks are worth more than the entire Chinese stock market combined. Highly valued at 29 times price to earnings, believing that it is not a good investment at this current time. So now, after going through so many reactions and reports after reports, what is your immediate reaction when I threw all these arguments in your face over the last minute or two? So it sounds convincing, doesn't it? Most of them are citing pretty credible sources like Bloomberg and even Goldman Sachs. So what do we do now? Sell? Liquidate our entire positions? Since so many people are calling it expensive. Now, hold your horses. First, let's acknowledge the power and benefit of social media and the internet. Since the boom of this internet era, information is no longer the limiting factor. Everything is just one Google click away. What about the downside? It inevitably creates many mini echo chambers due to how the algorithm is structured to keep you on the various platforms. So if you're bearish, like how I was conducting my research, it's probably going to serve you more bearish content to reinforce your existing worldview. The reverse is true too. If you are bullish, they will serve you extremely bullish case studies and talking points. So I think it is safe to say that both sides of the argument can sound extremely convincing, depending on who's on the receiving end. Now, with this backdrop in mind, let's go back to answering the question of whether the US stock market is truly too expensive today and what should we do about it. But before that, I think I should provide a brief counter argument to some of these posts that I shared earlier. If not, some of you might mistake that I'm a huge bear right now. So on the point on the price to sales ratio made by Kobeisei letter, price to sales is just one of the many valuation metrics investors look at in totality. So it can be misleading if you're trying to insinuate that this current bubble that we're in might be bigger than the dot-com in the 2000s, but at the same time not furnish other details in that same period too. So price to sales literally just looks at 2 variables. Price, which is the overall valuation, compared to sales, which is the total revenue derived by these underlying companies. So what about their growth rates, their margins, their addressable market, how big can they grow into? And I would reckon that the answers to these questions might give you a clearer picture of whether stock valuations today are really just expensive and driven by exuberance, euphoria, investors' excitement, or by fundamental earnings ability and growth when compared to the year 2000s to today. Next, regarding the comparisons between the top 7 US stocks with the entire Chinese stock market. Similarly, I think this is a rather crude comparison without much merit and details. So it could definitely be that the 7 US stocks are expensive, or even the entire Chinese stock market being extremely cheap, or that the US stocks are justified because of their superior economics, their superior growth rates, and the ability to just extract profits and margins without much interruption or disruption. The last part, where someone cited a Goldman Sachs report comparing current valuations to the macroeconomic environment. It seems like there is some utility when looking at the extremes, like the dot-com era, where the model actually simulated a more than 100% overvaluation back then. So I really enjoyed this discussion with Howard Marks when he talked about the role of forecasting and using these forecasts to justify certain investment actions.
You dismiss forecasting, yet you are a great believer in or trying to figure out where we are in the cycle. Isn't that kind of counterintuitive?
It sounds it on the face, but I think there is a time when forecasting becomes more useful and that is when we're at an extreme. That the biggest mistake people make is to believe that a process, once in operation, will continue nonstop forever. That's what takes markets to extreme highs, which we call bubbles, and lows, which we call crashes. But when we're extremely high and people get excited and say, hey, this is going to go on forever, usually it will collapse eventually of its own weight. So when the market is crazy high or crazy low, I think we can make a profitable forecast. The only thing is, Nikolai, we don't get too many opportunities. Speaking with my son when I was writing that book on cycles, and I said, I think my market forecasts have been about right. He says, yes, Dad, that's because you did it 5 times in 50 years. 5 times the market has been at such an extreme that regression toward the mean has been dependable. Not in terms of when it will happen or what will cause it or how fast it'll happen, but the fact that it will.
Where are we now?
I think we're in the middle ground. I think we're a little bit above fair value, but not so high that a decline is predictable or dependable.
How many more good years do you think we'll have?
Well, see now, but you've crossed the line into asking me to make a prediction as to time.
Right.
One of my Oak Tree colleagues in his quarterly letter to his clients stated his rule. If you name a price, don't name a date. Right. If you name a date, don't name a price.
Yeah.
And then you can never be wrong. Here's the important thing to think about, which I don't think many people do. Let's say that you and I can agree that the S&P is 20% overvalued today, which I think is probably a good estimate. The PE ratio is 21. The post-war norm is 16. So 25% overvalued. And let's say we're right. The next question is, what is the probability that it's going to decline in the next year? It's modest. It's probably a little better than 50-50, but it's not 100 or 90. Lived as long as you and I have, we've seen markets that were overpriced become more overpriced, and then more overpriced, and then get into a genuine bubble.
And I think that Howard Marks hit the nail right at the head. Even if we can all collectively agree that the market is overvalued today, down to the exact percentage point, like the Goldman Sachs research. And let's hypothetically say that the market is overvalued by 42.69% today. What can you do about it? Does it mean that the stock market will immediately correct back down to fair value or to whatever value that you think is fair? I think the answer is hardly. Because if the market is so efficient, there will be no opportunities and bubbles will not be created in the first place. And no one knows for sure if the underlying economics of the businesses could potentially catch up and these seemingly overvalued market can become undervalued again because the fundamentals are catching up with this new environment. So then begs the question, what should you and I do right now? So as cliche as it sounds, this is my personal opinion of course, the best answer for now is to just stay invested. So I know that some of you might think that, oh, this is extremely lame. I want it to be much more action-packed to know when to exit and when to enter back in. But if your process is decent, as Terry Smith, one of the greatest investors, says, just buy good companies, don't overpay, and just do nothing. And your results will probably turn out alright. Despite many of these stock market talks about whether we are currently overvalued or undervalued, whether you should buy more, whether you should sell, for now, I don't think that we are near extreme greed or optimism. Maybe for a few companies, yes, but not in a broad, general stock market sense. So personally, at least in this current stock market, I do think that there are still many opportunities and I'm still deploying my capital, albeit much slower. This is what I'm currently holding and doing. I know that when we talk about AI stocks in general, it's really just the Magnificent Seven that most people are paying the most attention to. And I'm just comparing the 5 out of the Magnificent Seven, excluding Nvidia and also Tesla for now. Why, you might ask? Because Google Finance only allows me to put 5 stock charts at one go to present the data to you. Just kidding, of course. But the real reason is that I think both Tesla and Nvidia are trickier companies to talk about, especially in a very short YouTube video. There are many investors having very, very differing opinions about both companies. So I just want to keep the current discussion simple and just talk about these top 5 names. And when looking at these 5 names for now, I personally have 3 out of the 5, which is Amazon, Meta, and Alphabet. I've made separate videos on all 3 companies before in my channel. So if your question is, hey, why I don't have the other 2? My answer is simply, I would love to own both Apple and Microsoft as well, but at valuations that I personally favor, rather than current ones. And if you're asking me if these 5 companies are still a buy right now, I think you really have to do your own valuation work, and you can't just rely on some random guy, like myself, on the internet. But I can share with you that I've since averaged up in all 3 of my positions in the last 2 months. So the last I've added Meta was at roughly $440 in late April, Google at $165 in early May, and Amazon at $183 in mid-June. So of course, this is not an endorsement of the valuations today, but I'm just sharing what I've been doing. And just take note that I have much lower cost basis because I have started the position much earlier. Now, for those of you interested in my thoughts on the markets, do join my fortnightly newsletter in the link below, where I'll be sharing some contemporary resources that I've came across that I think would benefit you, and maybe also some contrarian opportunities that are catching my attention in the markets right now, especially if you think that everything is frothy. So are you still buying these Max 7 names at current valuations? Leave in the comments down below. And I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!